And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing great. How are you doing this evening?
I am doing great too. It's always so good to see you. And you've been very busy.
Oh my goodness, we've been swamped.
Yes, so I know that people are really enjoying the shows and they're calling in with some really amazing questions. And I love that part of the show that we get to at the end, which is the viewer questions, of course.
Yeah.
But I know your appointments have been very busy, so tell the viewing audience a little bit about what's been going on at the office, if you will.
Well, obviously we were playing catch up for a while here, but we're getting into the season. As we near the end of the year, we start doing a lot of planning, a lot of tax planning.
Okay.
Where normally the planning, people do a lot of the tax planning, if they do any at all, all year long. We like to hold off towards the end of the year.
Okay.
The reason being is we want to make sure we can look back on what's happened in your situation throughout the year, just to make sure that we don't create any additional tax implications that prevent you from, enjoying your retirement later on. So, but no, we've been absolutely swamped with business, and it's been great.
Sure, absolutely. And I know there are so many questions. We've talked about this a little bit in the past, but taxes play such a huge component for retirement when people are planning out how they're going to retire comfortably, and obviously all the buckets that they should be concerned about. Tell me how taxes plays into that, if you will, Stewart.
Well, as you know, we have a full tax preparation office, but the tax preparation is really just the beginning of what we do when it comes to taxes.
Okay.
The purpose of the tax office isn't just to prepare taxes, it's to do the planning. And the nice thing is that once we have all of the information, the tax information, it's really easy to create modeling to add additional tax implications. For example, I think most people realize that we are in the lowest tax environment in history right now.
Yeah.
And after all the stimulus packages, someone's going to have to pay for that. And I think it's also, there's a consensus that taxes are going to raise. Now, one of the candidates is talking about getting rid of step-up in basis on capital gains and actually taxing capital gains at ordinary income. Now, I'm not here to debate whether that's right or wrong, but just understand, there's some major future implications if the situation now changes. So what we're seeing is a big rush out the doors to create some real plan. We are in the most efficient window in history for taxes, and we need to take advantage of it. And I really do say that if your advisor isn't planning around where we are right now, we've got this really efficient window that we know is going away, and it's essential to take advantage of it while you can.
Sure.
We can do a lot of things at a discount right now that we don't believe will be available later.
So without having your crystal ball, Stewart, you're thinking that maybe taxes are going to go up in the future?
I've been wrong before, but that's my guess, absolutely. So, we just have this historically low, rate here for the average American. And I think it's huge to take advantage of it. I think it's really important to.
I do too.
Yeah.
I do too. Great advice. Absolutely. We hear so much talk right now about Roth conversions on an IRA. Can you explain to the viewing audience, is that an easy thing to accomplish? Doing a conversion?
Absolutely. The conversion itself is just signing a piece of paper, converting it from one account to the next, transfer. Okay. The difficulty, the magic of the whole thing is really understanding whether it makes sense for you and over what period of time. So let's just say somebody has $1 million IRA and they realize that when I retire, my IRA is going to start impacting the taxation on Social Security, my pensions, all of these other things. Well, it's really important to start as early as possible on Roth conversions and not to delay, because there's also some downsides. There's a 5-year wait to access some of those funds tax-free.
Okay.
Right? So it's important to really make sure that you start the timer if you don't have an existing Roth now. If you have an existing Roth, sometimes it makes sense to convert into that existing Roth, but it's easy to functionally do it. But from a cash flow perspective, that's what makes our job easier. When I talked earlier about having all of the tax information in our system, we have the greatest tax software available.
Okay.
And all we have to do is say, what if we convert $10,000 or $20 or $50 or $100 or $500 or $1 million. You know, we had one of our great clients came in, he sold a big piece of property, and he had a couple $1 million IRA, and we made a suggestion to convert the whole thing at one time. Well, that would put him in the 37% tax bracket. But guess what? After we did the cash flow analysis, he was going to be there anyways for the rest of his life because of this big sale of the property that would create dividends, capital gains. And I think his CPA, when he passed it by him, he thought we were morons at first. And then what we did is we showed him the cash flow work.
Okay.
And oftentimes people react viscerally to their first impression of, no, you don't want to convert it at 37%, right?
Yeah.
But if I can pay 37% today, and then that pushes me down to 22 for the rest of our life,
Yeah.
maybe it makes sense.
Absolutely.
And so I don't think it's safe to kind of stick to your guns and, you know, just say, hey, we never do this or never do this. We just model it out. And sometimes there's surprises in there that you don't even think through.
Sure.
You know, when you model it out over 10, 20, 30 years, you say, wow, you know what? I never thought that, you know, it would affect Social Security this way.
Sure.
And so sometimes the answer you didn't expect is actually the right answer.
Absolutely. Well, thank you, Stewart, for actually taking all the time to really take a look at each individual situation for each client that you have, because that's so important. As you mentioned before, retirement is not one size fits all, and neither is planning for taxes.
No, absolutely. You know, it's really important to make sure each case is taken individually when it comes to tax planning.
Yeah.
You know, everybody's situation is different. For some people, you know, Roth conversion doesn't make any sense. And I think it's important to have a real cash flow analysis to tell whether or not it does make sense.
Absolutely. Wanted to also ask you a question, if I could, Stewart, about how people could invest in their heirs' college education tax-free. We have a lot of parents, obviously, that are planning with their children going to college, but also it seems like grandparents now are also taking that into consideration. They want to help their grandchildren. So do you have advice on that?
Yeah, so there's a couple ways to approach it, and I think we approach it slightly differently than most people.
Okay.
It's always nice to make sure that you have college funding set aside for college because you know it's paid for.
Sure.
But on the other hand, if a grandparent, for example, funds a 529 plan, what they're doing is they're inserting assets into an estate that'll be looked at. So when you apply for federal aid, you have to disclose those assets that are available. And oftentimes, those accounts that people contribute into will disqualify you from future grants in aid that you would otherwise be available for. So if you have a grandparent that wants to pay for college, sometimes it makes sense for them just to pay it as it goes rather than to have an account in your name or create a 529. Because nobody looks at your grandparents' assets when considering college because it's not included in the FAFSA.
Okay.
Yeah, so it's really in the FAFSA is a free application for federal student aid. It's a very detailed questionnaire about your financial history, all of the assets you have available that qualify you or disqualify you for student aid. So I think being prepared is essential, but oftentimes there's some big pitfalls that will disqualify you from student aid. And I think it's really important if you have a grandchild that's going to college and you really want to help, oftentimes you're just throwing your money away by disqualifying them for, you know, aid they would otherwise be able to receive.
Excellent advice, Stewart. Thank you so much.
Yeah.
It's about time for us to open up the phone lines for the very first time this week. Can you tell the viewing audience what they can expect to receive by being one of your first 10 callers?
Sure. Yeah. If you're one of the first 10 callers, what we'll do is we'll do a complimentary portfolio review for you at no cost. If you just call 833-652-7829, we'll do that review, and that includes an analysis of all the fees on your portfolio, all the risks, how your funds interact together, and we'd love to help.
Thank you so much, Stewart. To the viewing audience at home, the phone number once again is 833-652-7829. We have added an additional phone line this week. We realize the phones have been busy. So again, for your convenience, the number is 833-652-7829. We have to take a very short commercial break, but when we come back, we're going to have more questions and answers about planning your perfect retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old they've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's managing partner of Asset Preservation Tax and Retirement Services. Stewart, another great show, and I love just talking about planning for college and how people can be prepared for that. I think one of the things that we should dive right into right now, I want to talk to you a little bit about rebalancing a portfolio. Do you recommend doing so, and how often do you request people take a look at that to rebalance, if you will?
Well, I think for the individual investors that have never rebalanced, I think it's critical, right? Because most individuals are buy and hold people. They, either they buy something they like, they buy more of it, and oftentimes those things get out of balance. But the way that we manage money is a lot different. So there's a passive approach, and then there's a tactical approach. We are a very tactical company. So in a normal passive environment, they would buy 60% bonds, 40% stocks, or vice versa, or whatever combination they're in that measures up to their risk tolerance levels. And oftentimes you have overperformers and underperformers, and what rebalancing is simply getting those numbers back to square, where you want them, where you're comfortable in your risk tolerance. So if something does well, you're actually getting rid of some of it to create more balance in the underperformers. What we do is a lot different. We use a tactical approach, and some of the way that we manage money is using institutional money managers. So that tactical approach is a lot different. The passive approach is much less expensive. You just kind of buy, your percentages, and then you have a computer, you push a button once a quarter, and it just kind of equalizes. It's very easy. It's kind of a low cost way for advisors to do it, low time consuming. The tactical approach takes a lot more work. In our tactical approach, basically creates an environment where we analyze where we are in the business cycle. And logically, you would believe that if we're in a recession versus an expansion in the business cycle, that there are two different, these are two drastically opposite directions that the market's going, right? And so having investments that are identical in both situations usually doesn't make any sense. We've identified 6 of those business cycle stages, and we believe that there are individual investments that work better in each of these stages, or a different set of investment in each stage. So part of the algorithm we use in our money management system is to analyze where we actually are in the business cycle. And our institutional money managers simply move the assets rather than rebalancing. They say, okay, well, if we go from peak to trough, there's a stage that we believe in a set of investments that will perform better in that environment, so we go there to that stage. That's why our goal isn't to beat the market on the way up; it's to not lose on the way down.
Sure.
Yeah, and our whole approach is around it revolves around drawdown. And what drawdown means is loss. A lot of financial advisors don't talk about loss with their clients, and that's a huge part of what we talk about. Because you may say, look, I'm willing to lose 10% or 15%, but when we put that into dollars, let's say you have $1 million to your name, I say, hey, are you comfortable if the market drops 25%, that you lose 5%? And you say, yeah, that's okay. How about 10? I don't know. That's $100,000. What about 150 or 200 or 300? Everybody has a pain threshold they're not willing to, go to, right? And so our portfolios are designed around what you're comfortable with if, in worst case scenario, if the market pulls back. And it's a completely different approach, but what it does is it allows us to really mitigate that downside risk if something bad happens. In COVID, for example, our portfolio that's designed to have a 10% drawdown saw about 9.5. The rest of the market, saw 30 or so. And so, once again, we're not trying to chase them on the way up. We're trying to not lose on the way down.
Right. And so, I'm sitting here, I'm listening to you, Stewart. I wonder, why doesn't everyone take that approach to helping their clients? Because it seems like that is the most comprehensive, hands-on approach to help someone get through these challenging times when they are challenging.
Well, the reality is it's a lot of work. And, brokers are the guys who, they work 2 or 3, 4 days a week, and they golf 2 or 3 days a week. And, that lifestyle is nice, right? Everybody remembers the old wealthy stockbrokers that worked a couple days a week and, they golfed the rest. And that would be a great life. It just doesn't work for us. We're a way more hands-on company because of the planning aspects of what we do.
Absolutely. And I think for the viewers at home, we should talk about the importance of having a fiduciary on their side. Can you explain what that means?
Absolutely. So a fiduciary is somebody who has an obligation to the client first before ourselves. So a regular broker, which is what you see at big box financial advisors, they're generally stockbrokers, Series 7 brokers.
Okay.
And they receive commissions for the sale of, mutual funds sometimes. They're allowed to receive back-end fees from the mutual funds and ETFs. We're not allowed to. So as a fiduciary, I am prohibited from receiving any of that back-end commission. If there is any conflict of interest, we have to disclose that in writing to the client to let them know of any potential conflicts of interest.
Okay.
So it's super crucial to have a fiduciary. I think whether it's with us or somebody else, you need to do business with somebody that's a fiduciary. That should be the first question you ask.
Sure.
Because it's critical. And, we have offices in Sun City, Peoria, also in Scottsdale. So we're on both sides of the valley here. And I'm telling you, in both locations, that's a very important question to our clients. And, we see different questions in different locations. Things are important to, different things are important to different people. But universally, the fiduciary question is huge.
Absolutely, because that lets someone know that you're putting their best interests first. You're giving advice like you would to your own family.
Absolutely.
Yeah. And that's so key and important. Well, we are about to that time where we're going to be opening up the phone lines again, Stewart. So what can you tell the viewing audience about what they can receive by being one of your first 10 callers, actually the next 10, I should say.
Right. Well, for the next 10 callers, what we'll do is we'll do a complete portfolio analysis, and we can tell you whether you're in that passive approach or in a tactical approach. We can take a look at what we see historically from the way that your assets are performing. We can also look at any sort of hidden fees, any costs that you may not know about, and also how those funds interact together, and what could happen if the markets have a downside. What kind of risks are you taking? Oftentimes people have no clue that, if we go through a scenario like 2008 again, they have the potential to lose 30 or 40%. And it's important to know. You just want to make an informed decision. So if you call 833-652-7829, we'd love to do that portfolio analysis for you.
Stewart, thank you so much. To the viewing audience at home, the number to call once again is 833-652-7829. We know you have a lot of questions about retirement, and Stewart is here to help you with all of those questions and provide excellent answers. Again, we have to take a very short commercial break, but we'll be right back momentarily, so please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's Managing Partner of Asset Preservation Tax and Retirement Services. An excellent show, Stewart. I love everything that we're talking about. And this is my favorite time of the show because we get to go through viewer questions. And when you and I are talking and the phone lines are starting to open, we see the lights coming on.
Yeah.
And we never know what the questions are going to be like. So if you don't mind, I'm just going to jump right in and we can have some viewer questions today. Does that sound good?
Sounds great.
Okay. Awesome. So the first one is, Stewart, I have not yet retired. I am considering purchasing an immediate annuity using all the funds in my 403b plan upon retirement. Would the annuity distribution satisfy required minimum distributions? How will placing the entire amount in the annuity be taxed? And how will the monthly payments be taxed? I enjoy your show each week, Stewart. Thank you so much.
All right. Well, that one is a fully loaded question here. Well, so if you put everything into an immediate annuity, what that's going to do is convert your value. So let's say you have a $500,000 IRA, you're going to convert that into a lifetime income stream. And depending on how you structure that immediate annuity, generally it's a lifetime product. When you pass away, if it's just simply for life, if you pass away, those assets pass away with you. They die with you. So you're giving it back to the insurance company.
Okay.
And oftentimes if people do an immediate annuity, they'll say, for life, but guaranteed for 10 years, 10 years certain. So it'll at least guarantee payments for 10 years for your heirs. But it's not usually a very efficient way to do things. The one thing to think about is it's taxed in the same way your normal IRA would be taxed. Yes, it will satisfy your required minimum distributions as well over your lifetime. But what's really important is to realize that we're in the lowest interest rate environment in history. So if you're committing to a product, right, it would be like buying a lifetime CD right now.
Okay.
Does that, everybody knows you're not making much. You might see 0.5%, 1% on a CD. Why would you commit to that horrendous interest rate for the rest of your life?
Yeah.
Right. So, we believe that in, a few years, interest rates are going to be higher. So you certainly don't want to commit to this really, really low interest rate environment forever.
Sure. That makes total sense.
Yeah.
Thank you so much, Stuart. We have another question here. It says, Stuart, an IRA is being willed to me. If I inherit it before the age of 59 and a half, can I have it sent directly to my own IRA? And what are the tax implications?
So you're no longer, so there have been some recent changes in the way that the IRAs are treated for heirs. And if, in the past, if for non-spouse beneficiaries, they were allowed to receive or inherit an IRA and be able to stretch that out over their lifetime.
Okay.
That's no longer the case. Now, the Secure Act, which was passed towards the end of last year, basically says that those funds have to be exhausted within 10 years. So when you used to be able to create your own beneficial IRA or inherited IRA, that could last you for the rest of your life, now it has to be gone within 10 years. So once again, let's use that case of somebody with $1 million IRA. Now, when you pass it to your kids, if you have one kid, for example, that kid's gonna have to take a $100,000 distribution a year if they do it evenly. or they're going to have to take $200,000 in one year, $50,000 in another, but it's going to really push them up in tax brackets.
I was just going to ask you that.
And oftentimes you have to think about the fact that, you know, when you're passing those assets to the kids, you're retired, but they may still be working and they may be making a lot of money at work. So what you're doing is forcing them into this really bad tax bracket unnecessarily. That's why it's really important to do the planning, like we talked about at the beginning of the show around Roth planning, tax planning. It's super, super important to plan around the tax implications.
Thank you so much, Stewart. We have another question, actually.
Yeah.
My spouse and I are 70 and 67 years old and retired. We have a fixed and variable annuity. Is this a good investment for monthly income? We sometimes need extra income for home maintenance. Any advice you can give and provide, Stewart, we greatly appreciate.
Well, so when it comes to variable annuities, I'm not a big fan at all. Variable annuities, to me, are what give annuities a really bad name. They're expensive. You know, what a variable annuity basically is, it's a group of mutual funds that have an insurance wrapper around it that may guarantee you a lifetime income, but what they're doing is eroding the underlying value with fees. So oftentimes we see variable annuities with up to 4% in fees, sometimes slightly over 4%. And just think about this. If you've got a lifetime income rider on there that you're paying 1% on, you've got fund fees for 1%, you've got mortality and expense fees for 1%, you're now up to 3%. Well, from 2000 to 2012, the S&P 500 made nothing. It literally took 12 years for the S&P to come back from, you know, the dot-com crash. But if you're paying 3% of additional fees on top of that, assuming that you just followed the S&P 500, you're down 36% 12 years later because of those fees. So it's super important to make sure you understand all of those underlying fees and know what you're paying for.
Sure. And then this one says, Stewart, I am 10 years away from retirement. Is it too late for me to start a retirement plan?
Never. No, it's super important. Start now or you're not going to make it.
Okay.
You know, it's really important. You know, from a tax perspective, we can really create a nice plan when we have time, when we're ahead of time. So we want more time than 10 years generally for, you know, starters, but whoever you do business with, you need to do some planning. Absolutely.
What a wonderful show, Stewart. And speaking of time, we're actually at the end of our show already. I can't believe it. There's only about 30 seconds left. So again, it's just been an amazing amount of information that you've been able to deliver. And again, to the viewing audience at home, thank you so much for watching. The number to call is 833-652-7829. The phone lines are open, and to have your opportunity to sit with Stewart, please call right now. Once again, the number is 833-652-7829. We look forward to seeing you next week. Be safe and be blessed. Thank you for watching.